I was at a conference. This was right before COVID hit, and I was at a company dinner. We'll leave them nameless, but they invited, some hedge fund managers, family office managers, some newsletter writers like myself, and I struck up a conversation with a gentleman who was a hedge fund manager, and we started talking about gold versus being invested in the main stock market, the S&P. And I said, well, come on, he was kind of debating me a little bit because he knew I was kind of a gold bug. And he said, well, come on, the S&P's outperformed gold. And I said, are you kidding me? I said, gold has outperformed the S&P century to date. And again, this was 2020, but still 20 years. He didn't even know. He actually started laughing at me. And this is a hedge fund manager, someone who's managing money for a living. He didn't even know that gold was trouncing the S&P. It still is. And he didn't know that. So I'm really curious if he still has his job. But that shows you like a lot of misunderstandings that are out there. And he's a broker. He works in the industry and he didn't even know that.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the two most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode. Jamie, I want to pass the same or similar question to you. When it comes to macro signals, macro news, do you have your head up and eyes open? What are you watching? Or are you detached from that and you focus on your thesis similar to Jeff?
So you made an interesting point in your introduction where you said, people are just waking up right now to what's going on in the world with changing events. During COVID and since that time, we've had war, we've had plague, we have had talk of famine. There's been, the 7 horsemen of the apocalypse, and gold is only starting to move now. And, the question of why that is, I think can be answered with 4 letters. AISC. And for anyone that's ever read anything about a gold company or any mining company, that stands for all-in sustaining costs, which is the measurement of how much it costs to mine 1 ounce of gold. And that has been going up and up and up with inflation. Unsurprisingly, the biggest input for most mining operations is diesel cost. As energy prices go up, it gets more expensive to mine. As wages go up, it gets more expensive to mine. As commodities and infrastructure and all the inputs you need go up in price, it gets more expensive to mine 1 ounce of gold. And what I see happening, this escalation in price is like just an escalation in price of gold is a reflection of an increase in the cost of mining an ounce of gold. And I think that's what's driving it right now, because there are many, many mining companies, major mining companies right now that are making less today at, what are we at now, $2,400 an ounce gold than they were at $1,800 an ounce gold several years ago.
Yeah.
What does that tell you about the market? Meaning, like, could you qualify today's gold market as a supplier's market or a buyer's market? Because, one typically drives the other. And if there's enough demand, then suppliers can name their price.
So it's good to take a step back and think about that, right? Because, when you invest in most businesses, you're looking at their margin, right? And you think of like what a great tech business can do, and it can be 80-90% margin. A great, manufacturing business or sort of traditional business, 40, 50, 60% margin. Traditionally, in commodities, particularly in mining, you see about a 15% margin on average across the cycles. And that's a really shitty margin. So to make 15% profit. So to put that into perspective, Costco, which prides itself on being the cheapest operator on the planet, has a mandate that they can only have a 14% margin. So basically the commodity industry operates like a Costco, and no one has to buy a membership to be part of the commodity industry. So it's traditionally not a great business, which is why so many people lose money in commodities. But what's unique about commodities is it's an incredibly inelastic business, right? So you all know this. Most of your listeners will know this too, that when price escalation starts or when demand comes on, you can't turn a new mine on tomorrow, right? You can't just bring in that, extra million or 100 million ounces of gold or pounds of copper or barrels of oil, whatever. Oil's a little less elastic, but particularly mining, it's very, very inelastic. So what you have then when that supply crunch actually hits, all of a sudden you get massive escalation in price to bring on that supply. And that's when investors can make a lot of money. So that's all kind of a convoluted, long answer to, I think it is a buyer's market today of gold and gold equities. And the reason I think that is because gold companies are not making the profit margins they should. And at some point, price of gold has to escalate to incentivize that. That's my view.
So this is the beginning of that process. If I'm interpreting what you're saying correctly, you think that reckoning is coming. We're seeing, the gold price rally, but, how far down that runway, if you were to speculate, Jamie?
I'm going to heed Jeff's advice there, which don't make predictions and don't put timelines on them. But listen, I've been buying gold stocks just this week, or last week rather. The reason I'm buying them is because I think gold price is going to be going up. So I know I'm directionally right. I don't want to put a timeline on it.
Yeah, I thought I could bait you there with a timing question, even though I never give forecasts myself. I appreciate
I've got it wrong so many times in the past, so I think I've learned my lesson at this point.
It's the best it is the best answer to that question, is that I don't time markets.